According to mounting concerns from banks and analysts, the US economy could enter into a recession soon as a sudden spell of pessimism strikes the financial markets. We have a good cause to believe we're already neck deep in, since we have recently fallen farther from previous lows. If you want to know what experts are saying about the coming recession, you should keep watching. You'll also learn the truth about the recession, about why it's inevitable, and what you should expect, in order for you to properly plan ahead of the coming recession. Despite the fact that important aspects of the economy, such as the employment market and consumer spending, remain strong, there are growing concerns that rising borrowing costs for individuals and businesses, following years of near-zero interest rates, might lead to a sharp slowdown. So far, this year, the Federal Reserve has lifted interest rates by 0.75 percentage points, with officials indicating that more aggressive rises may be required to calm the economy. The coronavirus pandemic's unpredictability, as well as Russia's invasion of Ukraine, are adding to the unease. This is what the chief economist at Moody's Analytics, Mark Zandi, has to say. Recession risks are high, uncomfortably high, and rising. For the economy to navigate through without suffering a downturn, we need some very deft policymaking from the Fed and a bit of luck. Is he the only one speaking? Not at all. Former Goldman Sachs CEO Lloyd Blankfein warned of a very, very high danger of recession. Wells Fargo CEO Charlie Scharf said there is no doubt that the US economy is headed for a downturn. And former Fed Chair Ben Bernanke warned of stagflation, or a slowing economy mixed with high inflation. These worries come amid a slew of data pointing to an economic slowing, particularly in interest rate-sensitive industries, which are already suffering the effects of the Fed's commitment to tightening monetary policy. In April, new home construction halted. The demand for mortgages also continued to dwindle because of rising costs and overstocked inventory issues engineered to avoid supply chain interruptions. Some of the country's largest and most prominent retailers reported poor sales and profits in May, sparking a stock market crash. The prognosis for the US economy is dimming due to international turmoil, particularly the likelihood of a recession in Europe and China. A stronger currency, which makes dollar investments more appealing as interest rates rise, might restrict exports, increasing the risk of a technical recession in which the economy contracts for 2 quarters in a row. Fears about a deteriorating economy and changes in consumer buying habits have driven some high-flying internet darlings, such as Netflix and Peloton, to lay off employees in recent weeks. Twitter and Meta have put their hiring plans on hold, while Amazon leaders recently admitted that the business was overstaffed following months of aggressive hiring. Recently, national unemployment insurance claims rose to 218,000, a 4-month high but well below historical lows, which is still near 40-year highs, has emerged as a major issue for the economy and the Biden administration. Food, gasoline, and housing prices are all rising, burdening Americans' wallets and clouding their outlook on the economy. The University of Michigan's carefully monitored Consumer Sentiment Index shows that Americans' perceptions of their current finances and future prospects have deteriorated dramatically in the past year. Despite their pessimism, Americans continue to spend lavishly. Even if the US avoids a recession in the short term, some economists believe that the rapid pace of inflation, which has risen 8.3% in the past year, as well as the persistent supply and demand imbalances caused by the pandemic and the policy responses to it, could lead to a more severe crisis down the road. The number of new homes built decreased in April, owing to a slowdown in single-family homes. According to data issued this week by the Census Bureau and Department of Housing and Urban Development, building permits, which provide a view into future construction, have also decreased. As a result of the diminishing demand for home loans and refinancing, major mortgage lenders throughout the country, including Wells Fargo and Better.com, have laid off thousands in recent weeks. Mortgage lender Kevin Retcher of Alexandria, Virginia, said that there is a notable apprehension among potential house buyers. Late last year, around the time the Fed began signaling imminent rate hikes, refinances began to fall. Rising mortgage rates, now at 5.3% for a fixed-rate 30-year mortgage, about double what they were in early 2021. And sky-high home prices have begun to dissuade purchasers in the months afterward. Consumer demand is dwindling in other sorts of small enterprises too, as customers deal with growing expenses. Thank you for watching, and I'll see you in the next one. Don't forget to subscribe to this channel for more amazing videos.